Hello and welcome to another TLC Tutoring Company accounting video. Like I said in the intro, we are going to be getting started with step 1, which is journalizing transactions. I'm going to begin by opening up a second window so that I can work side by side, and I encourage you to go to our website and download this spreadsheet so that you can do the same. So as you can see on the left-hand side of our screen, we have a series of transactions to journalize. Notice that this is the first month of operations for this corporation. They were incorporated on January 1st of, let's just call this year. And it does tell us how many shares of common stock and preferred stock are authorized. So let's take a look at this first one on January 1st. They are telling us that on January 1st of this year, our corporation issued 5,000 shares of common stock at $32 per share. Now, you might remember from issuing stock is that we always value common stock at par, right? So this $32 per share, that's telling us how much cash we received. So I guess let's go ahead and start there. So we know that we're issuing something, which means we're giving it to the public, which means in exchange we are receiving the cash. So our cash is increasing. You might remember that cash is an asset. And then again, what makes cash go up? A debit. And actually, let me put our debit and credit rules off to the side just so that we know we have them. All right, so it's an asset. It's going up. It is a debit. So debit cash. And that is going to be for 5,000 shares at $32 per share. So we're getting $160,000. Now the second piece is we are issuing common stock. So common stock is going up. Remember, whenever we issue common stock, that's saying the amount of ownership is increasing. So common stock is going up. Common stock is a capital account. So we are going to increase it with a credit. Now here's where we need to go back and find some additional information. It says that 5,000 shares were issued at 32, but this doesn't give us our par. So let's take a look at this information here. It tells us that the corporation has 1 million shares of $5 par. So this is a $5 par common stock. Right? So when we are doing our journal entry and we're crediting common stock, we are going to value it at the 5,000 shares that we are issuing times the $5 par. Right? And then that begs the question, what is going to be that last account that we use in order to make these balance for that $135,000 credit that's missing? That will be, and we can even kind of go up here for a little cheat sheet. We have our common stock that will be paid in capital in excess of par dash common stock. There we go. All right, that's it for the first one. Let's go on to the second one. Again, on January 1st, we paid $18,000 for 3 months rent in advance. You might remember we're seeing paid $18,000. Right off the bat, we know cash is decreasing. So let's do that one first. So cash is decreasing. Ask yourself, what type of account is cash? Cash is an asset. Decreasing, we're going to have to credit cash. Now keep in mind, as always, our debits will come first. So since we're crediting cash, let's start on that second line. Okay. Now what's the missing account? The cash that we paid was for rent. And notice it's rent in advance. So since we're paying in advance, it's not an expense. It's going to be prepaid rent, the asset, right? So we're going to debit prepaid rent, the asset, to make it go up, to recognize that we have a future economic benefit for that rent. Okay. January 2nd, we purchased a billboard advertisement that will display during the month of January. So we have an advertisement here. It's going to be paid for this month. It's going to be advertised this month. So really, we just have an expense in cash here. We do have an advertising expense account. So advertising expense, to record that we have more expenses, we're going to debit advertising expense. Keep in mind, as we incur those expenses, we debit them to make them go up. No. There we go. All right. Next one, we purchase supplies for cash. Hopefully, if you're doing a problem that is at this caliber, this is kind of second nature to you at this point. So again, we purchase supplies. Don't get confused. Keep in mind supplies. We are going to need to use the asset. Later, once we use them up, then we'll have the expense. All right, so we are going to debit supplies to make it go up. And then we have a credit to cash because we are paying cash for those supplies. All right, also on January 4th, we purchased equipment on account. So the company's equipment, an asset, is going up. So we will be debiting equipment for expensive equipment for $54,000, and we didn't pay for it today. We are going to pay for it later. So that's going to be accounts payable. And remind yourself, what type of account is accounts payable? It's a liability, so we're going to credit it to increase. All right. Moving on to January 6th, we have some of the same type of format as we did on January 1st when we issued the common stock. So we're issuing 1,000 shares of preferred stock at $205 per share. So we already know our debit's going to be to cash. Again, very similar to what we did on January 1st, right? We're issuing stock, we're getting cash. So we issued 1,000 shares at $205 per share. So we're getting $205,000. We're issuing preferred stock. Remember, we always have to value it at par. The par on the preferred stock up here says $100 per share. So $100 par times 1,000 shares being issued. And then again, we are going to fill in that missing amount for paid in capital in excess of par dash preferred stock. 105,000. So again, as you're doing these, if you are kind of doing this problem to jog your memory or to kind of practice, make sure that you are comparing it to similar ones so you can kind of compare and contrast. See the similarities, see the differences. A lot of the concepts that you're learning are building on the foundations you already have. So if you have those, that core knowledge, you should be able to breeze right through this. All right, January 10th. Provided consulting services on account. So we have accounts receivable as our debit. Again, remember when we provide services, either we are getting cash or we are going to receive the money later. In this case, it says we've provided them on account. So that would be accounts receivable for $90,000. And then our revenue account is consulting revenue. All right, next we received an advance payment for consulting services to be provided during the next few months, $50,000. So we received cash in advance. So our cash is increasing. Again, cash is an asset. If you don't know how to categorize those accounts, please make sure that you're reviewing some of the past videos. It's going to be very important that you are super comfortable with doing that at this point. All right, so cash $50,000, and this was for consulting services to be provided in the next few months. So ask yourself, we're going to be providing the service later. So do we have revenue? No, we did not complete our part of the obligation yet. So in this case, it's actually a liability. It is right here, unearned revenue. We did not earn this revenue. We owe a service. It's a liability, right? So let's increase our liabilities by crediting that unearned revenue. Perfect. All right, January 14th, we made a partial payment for the equipment purchased on the 4th, $14,000. All right, so we know that we made a payment, so we know that cash is going down. So let's start with that. All right, next, think to yourself, what would be our debit for the 14th? In this case, please make sure that you're not putting equipment. We already recorded the full cost of the equipment back here. We are actually paying off the account payable that we previously created. So that accounts payable is actually decreasing by $14,000, right? The equipment is going to stay on our books at that full cost. All right, and then we have one more on the 14th, hired an administrative assistant who will be paid $3,000 every 2 weeks. Now remember, this is simply an event, right? So we had hired an administrative assistant. They have not worked for us yet. They haven't incurred any expenses. We didn't pay them in advance. So this one, the second January 14th, this does not require a journal entry. So for now, we are actually done with page 1 of the journal. Let's move on to page 2 of the journal in the next video. See you there.